Anastasia Amoroso, the managing director at Partners Group, recently expressed growing concern about the weakening labor market during her appearance on Fox Business's Making Money, describing it as a big question mark for the overall direction of the U.S. economy. She emphasized that labor conditions are one of the most critical indicators of economic health, and any signs of deterioration tend to ripple through multiple sectors, influencing everything from consumer behavior to corporate investment strategies. Amoroso noted that recent data pointing to slower job creation, modest wage growth, and increasing unemployment claims could be early indicators that the economy is entering a period of deceleration. For investors, this situation introduces a significant degree of uncertainty, as the strength of the labor market has historically underpinned consumer confidence and spending, which together account for nearly 70% of the U.S. economic activity. When people have stable employment and rising incomes, they tend to spend more freely on goods and services, fueling growth across industries. However, when job security begins to falter, households often cut back on discretionary expenses, leading companies to scale down production and hiring, which can further weaken the economy in a self-reinforcing cycle. Amoroso pointed out that the resilience of the job market over the past few years has been one of the key factors supporting equities, especially in the face of higher interest rates and inflation pressures, but with recent data showing a slowdown in hiring momentum, investors are starting to question how sustainable corporate profits will be in the coming quarters. She explained that the labor market does not just reflect employment levels, it also captures broader shifts in business sentiment, productivity trends, and wage inflation, all of which have direct implications for monetary policy and market valuations. A weakening labor market could potentially prompt the Federal Reserve to consider rate cuts sooner than expected, but Amoroso warned that such easing would only occur in response to deeper signs of economic strain, which could themselves weigh on risk assets. She also underscored that while some sectors, particularly technology and healthcare, may remain relatively insulated from labor softness due to structural demand, others such as manufacturing, retail, and construction are far more sensitive to employment shifts and consumer demand patterns. Amoroso's remarks reflect a growing debate among analysts over whether the current slowdown in hiring represents a temporary adjustment or the beginning of a more persistent downturn. Some economists argue that after several years of rapid post-pandemic recovery, the labor market is simply normalizing, with job openings and wage growth cooling to more sustainable levels. Others, however, interpret the weakening trend as an early warning sign that tighter financial conditions and Amoroso's comments on the weakening labor market came at a time when stocks were already under pressure following new tariff announcements, reigniting investor concerns about global trade stability and its ripple effects on corporate profitability. The market's reaction to tariff-related news was immediate, with major indices dipping as traders assessed the potential economic consequences of renewed trade tensions. Tariffs often serve as a double-edged sword. While they can be intended to protect domestic industries, they also raise costs for businesses that rely on imported materials and components, which can eventually trickle down to consumers in the form of higher prices. Amoroso pointed out that the timing of these tariff developments could not be more delicate, as the economy is already showing signs of strain from tightening financial conditions and slowing job growth. The combination of weaker labor data and fresh trade barriers introduces a potent mix of uncertainty that has the potential to dampen both business investment and consumer sentiment. Historically, tariff announcements have triggered volatility in equities, particularly in sectors like manufacturing, automotive, and technology, which are heavily exposed to global supply chains. Investors often respond to such developments by rotating out of cyclical stocks and into safer assets such as bonds, utilities, or consumer staples, reflecting a defensive stance. Amoroso observed that this latest market pullback fits that pattern, as investors increasingly prioritize capital preservation over aggressive growth bets. She also noted that corporate leaders are likely to respond cautiously to the changing trade landscape, delaying expansion plans or reassessing production strategies in light of potential cost increases and disruptions in supply chains. Many companies that depend on imported goods or raw materials could face margin compression if tariffs raise input costs faster than they can be passed on to consumers, especially in an environment where demand is already softening. This can lead to a broader slowdown in earnings growth, which, in turn, affects investor confidence and valuation multiples. Amoroso emphasized that while markets have grown somewhat accustomed to tariff-related headlines over the past decade, each new wave of trade restrictions brings fresh complications that challenge global economic integration. She explained that in the interconnected modern economy, tariffs do not operate in isolation. They affect not only the targeted countries but also allies and partners who are part of shared supply chains. For example, when tariffs are imposed on Chinese goods, manufacturers in neighboring Asian economies or even in the United States may experience collateral damage through higher costs or reduced export demand. This complexity makes it difficult for investors to accurately assess long-term outcomes, which contributes to persistent market volatility. Amoroso warned the